Hi, Andrew. Thanks for joining me today, and welcome to the Capital Podcast. Um,
Thanks for having me.
no problem. Now, we've actually tried to do this once before, but there's some technical issues, so we're jumping on again, and hopefully we can get some good information to get out to everyone. Now, for those who don't know, Andrew, you're an accountant. Is that right? Can you
Yes,
give us a bit of a breakdown of who you are?
sure. I run a practice called FTC, stands for Finance and Tax Consultants. We predominantly specialize in the tax advisory space. So helping people, whether that comes from businesses, SMSFs, individuals that have investment properties, that type of thing. We've been around for how long has it been? Like I think 6 or 7 years now. I've been doing this for about 15 years. So we have a
Plenty
team
of
based,
experience. Yeah.
plenty of experience, team also based in Bella Vista in the
Okay.
West.
Yeah. Awesome. Awesome. Which is also where we're located. So just around the corner, which is nice.
Yeah,
So you've been doing it for 15 years. I didn't actually know that.
yeah
That's a long time.
it's a long time. It's gone really quick.
Yeah.
I started my younger days back in 2010, I think it was. So uh, that's when I first started. But yeah, all that experience accumulated over time, and time has flown. It's 2024 now.
What made you want to be an accountant? When you were like 5 years old, you don't have 5 year olds walking around saying, I want to be an accountant one day. Maybe if their dad's an accountant or something, but what sort of drove you to think, oh, I want to do accounting?
Look, I was always good with numbers
Yeah.
and always wanted to be an entrepreneur, own a business. And I think for anyone that wants to start a business or do something for themselves, having the understanding of accounting and taxation is, I think it's it's a good skill to have because it's used across all facets of the business. Whether you're forecasting numbers, whether you're picking up clients, doesn't matter which type of industry it is. Essentially, it's exactly the same thing over when it comes to accounting and finance.
Yeah.
So
Yeah.
yes, there are special rules for different industries, but generally speaking, you know, if you're good with numbers, you're also going to probably be good at running business as well. That's what I think.
It's a big skill set that's actually missing. Obviously when we do a lot of our commercial finance applications, we get their financial statements and things like that. And even though the financial statements themselves are prepared by the accountants and we can go through them and understand them, we do notice that there's a lot of lack of understanding on what the actual numbers mean from the person giving me the numbers, not the accountant, the actual customer. Now, not they don't work in accounting industry or the finance industry, so they don't necessarily need to understand those questions. But like you were saying, if you don't have the fundamental understanding of those numbers and the profit and loss and the balance sheet and the quarterly reports and the interim statements and you don't know what that means for your business, then you're sort of swimming through a cloud, right? You have no you have no idea what's happening in the future and you can't plan.
100%. So you sort of get like bottlenecked. So, a lot of people reach out to tax advisors and get them to come in to help. And it always does make sense to get someone who's an expert in the field, whether it's a tax advisor doing tax work, a mortgage broker knowing which type of loan product to give, or a lawyer,
Yeah.
good knowing that stuff. It's always right to have the good type of the best professionals at your fingertips to help you with that sort of stuff, especially when it comes to business expansion. You need to understand the numbers really, and if you're going to employ staff, employees, that type of thing, you need to know what's going on before you can do that.
I think it's also important for people to know, maybe you can elaborate on it too, that accountants do come in all shapes and sizes. So, for instance, the best analogy is everyone sort of understands it when it comes to law, the legal profession. Everyone understands that you don't go, if you want to argue, if you want to do some conveyancing, you're not going to go to a criminal lawyer, right? To do your conveyancing because they specialize. But not many people actually know that these other professions like accounting also specialize. So you don't always go to the same sort of tax agent or the accountant to do all your accounting because they might not actually have that skill or expertise. Is that your experience? Would you say that's true?
Yeah, 100%. So we've picked up clients, business clients, and I can see the experience that whoever was doing it before probably wasn't the right fit for that business. And this is where it can also impede the decision-making process of that business. Because if you
Mm.
know the specific ways, structures that you can set up, for example, to streamline taxation, or there's structures that you could use to acquire properties, you need to have that knowledge. You need to have that knowledge before you make those decisions. Going to someone for the pure reason of just saving tax, well, yeah, you probably will find someone to do that, but they're probably not going to help you on the other side when it comes to expansion.
So how do you find the person you're looking for? Because we just spoke just before about how a lot of businesses don't even understand their own financials. So how do they know? How can a business owner know what they need and who to go for that?
Well, firstly, just reach out to us. Of course, we can help them. Uh,
Yeah.
but I think,
There's nothing you can't do. Nothing Andrew can't do.
look, I think it comes down firstly to having a good relationship with the person, with
Yeah.
whatever they're doing. So if you speak to someone and you have confidence to know that they're doing what they say they're going to do and they actually deliver, I
Yeah.
think that's probably the first point. So probably, getting understanding who they are, how long they've been in business,
Yeah.
what type of things they service, and then maybe give them a try. If you do like them after the first couple of months or the first few years, then you
Mm.
can to fully invest with them.
Yeah. Yeah. I do like that. I do like being able to personalize with the person you're dealing with. It sort of goes a long way in a lot of different professions. I'm the same, for instance, if I go to a barber who doesn't give me the right haircut, there's a very slim chance I'm going back to that building. Even if there's other barbers in that shop, it's like, no, I don't want to deal with it.
Yeah.
I'll just go to another whole new barber. Because that sort of personal relationship that you have with anyone that's giving you providing a service, whether it's accounting, finance, or barbering, um, it does go a long way. And I always say that when people say, what should I look for, Keaton, in like a conveyancer? Because we get asked all the time in finance, Keaton, what should we look for in a conveyancer? What should we look for in an accountant? What should we look for in a buyer's agent or something like that? And my answer at the end of the day is pretty much on line with that, what you just said, you have to be able to work with them. Like you have to get
Yeah,
along with them.
100%.
Yeah, and if you don't, it's gonna be a drama, someone that you can sort of question and go back and they can work with you that way. Now, I see a lot of your content online, and one thing I wanted to ask you is um, interest rates. I thought I may as well start off with the most topical thing at the moment. We've obviously seen how long? Almost 18 months over. How many months has there been an increase now?
Since
Um,
February 2022, I think. Yeah.
yeah,
So
so it's just been an increase, progressively over the last, ages. What's your feelings on the increases themselves? So the last
look,
couple years.
I think, of course, there was a big slowdown or shutdown of the economy in 2020. We all know what happened there.
Yep.
The RBA, as well as all the other central banks in the world, cut interest rates to spur demand.
Yep.
Did that? It did well. Unfortunately, I think it did a bit too well, and things have just gone up way too fast. Whether it's
I
property
think,
price,
yeah, I think
groceries,
there was a bit of speculation that actually didn't come into fruition, especially in relation to COVID-19 and things like that, where I can't comment for other economies, but from what I've seen and uh, COVID-19, they sort of put all these things in place like reduced interest rates, grants, superannuation access, all these different things to help spur on the economy and but no one was actually spending because we are all at home. So it was sort of like this issue where we all just end up coming out of COVID being all cashed up
yes,
and ready to spend. And I know for a fact that a lot of people even use some of their savings during COVID on deposits for homes, and things like that. So yeah, sorry to cut you off, but yeah, I was just thinking there's a lot of speculation and I think uh, the reason we did so well, probably too well, was for that reason. No one was actually spending during COVID.
100%. So I think the reaction that the RBA has done is probably in line with what they had to do because
Mm,
things are becoming a bit too expensive at the moment, whether it's property, groceries, or to
mm.
do anything, it's really expensive at the moment. And they have to increase the rates to start bringing down that demand. Of
Yeah.
course, it's probably not what everyone wants to hear because it does mean paying with mortgages, whether it's your house or as an investor,
Yeah.
does mean that your mortgage more expensive. You have less money to spend each week, so then you're going to spend less money in the economy. So
Mm,
I think they're doing what they have to. It's going to last a bit longer. I don't think they're cutting rates this year, to be honest.
mm.
Everyone's saying that they are. CBA's come out. I think I saw the other day, and all the other banks saying they're going to cut. Inflation's still at 4.1%. So I think if they cut now, it's a bit too premature.
Mm.
And especially because the housing market as well is a bit nuts.
Do they
If they
think, do you think they should bump it up again? Do you think that's going to happen?
Look, I don't think they will bump it up.
Mm-hmm.
Ideally, if they do bump it up, it will then change the sentiment of the market because
Mm-hmm.
everyone's expecting a rate cut. So
Mm.
now investors and homeowners are rushing to buy houses with the
It's
hope that
true.
they're going to cut rates in 2 months or whatever. I think if they raise rates, it's going to change that psyche really quick, and then things will change. But if they just leave them where they are, the market's going to speculate. Everyone thinks they're going to cut. No one knows, to be honest.
Yeah.
But
Yeah.
I think they're gonna stay firm this year. To be honest, that's what I
Mm-hmm.
think. We have the U.S. presidential election at the end of the year.
Yeah.
Let's see what happens with that. That's probably the most uncertain thing on top of Ukraine, Israel, and the Chinese real estate bubble that's popping at the
Yeah.
moment. So I think when all those things come through towards the end of the year and there's a change of presidency, if there is one, I think that's when things may change in terms of rates.
Yeah. Yeah. That's interesting. I there is a lot of sort of barbecue over the barbecue discussions about interest rates at the moment, and people are reacting to that. It's funny how much people will take the word of, an uncle or a family member or a dad or something who's over a barbecue. And they, some people come to me with a certainty that, in this month, it's almost like doomsday preppers, in this month of this year, we will see a rate cut. And I'm thinking, wow, that's pretty remarkable foresight to be able to predict it that well. But a lot of people have those feelings. I think January is probably one of our a bit busiest Januaries. If you've worked in finance, you'd know that January is notoriously a slow month. People coming back from holidays, people going on holidays still, and not many people are thinking about buying homes and making loan applications, and that usually picks up in February. However, this January has been very busy, and it's been a little bit interesting and a bit of a commentary of where the market's at. People are thinking, okay, great, we're finally at the end of rates. And sometimes I have to say to them, look, potentially, yeah, but we've only had 2 months of hold rates. Let's just let's just hold our horses for a bit, and let's not rush in with the expectation that rates are gonna plummet, or go back down to the 2% that everyone feels like they're entitled to. That even if rates do cut, it's not going to cut drastically back down to a historic low again like it was during COVID.
I agree with you.
Yeah.
Exactly.
So it's interesting. But now with sort of interest rates and mortgages and things like that, one thing that I asked in our original podcast, and I wanted to ask you again and get your thoughts on it. It's a question that heaps of my clients ask me, and I usually refer them to an accountant to go through it. But it's how should I structure? So in most cases they've got an own occupied property, and they go, okay, I wanted to invest. And again, these barbecue discussions where they speak to their friends and family and they say, oh, you have to put it 100% in your wife's name because she's the, income earner. And, or then you have to maybe set up a family trust and run it through a bucket company and have, unit holders and all these different things, unit trusts. And, and it's their first investment property. So when does that stuff become appropriate? And when shouldn't it be appropriate?
100%. Look, I think if anyone's deciding to do their first investment in property and try to develop,
Hmm.
the development game is a very dog eat dog space as well when it comes to property development, just because there are a lot of rules and regulations that you need to go past in terms of
Yeah.
hurdles before you can even approve to build the thing. So usually with things like that as well, there's a lot of holding costs, there's interests, and not only that, then you've got the actual construction. If there
Yeah.
are dramas in construction, if you're not able to sort of fund it through the period in between of the slowdown because there's an issue, for example, then you're going to get into trouble.
Yeah.
in terms of the different types of structures, it's all very dependent on how many people are involved, what exactly are you developing. There's so many different things. But usually what people try and do, if it's their first one, they'll probably just develop it in their personal names because they'll have the principal place of residence. It'll be
Hmm.
the easiest way to get the loan.
Yep.
With Finance City, obviously you can help them with that. If you're not using your PPOR, then and you have cash, then you could probably open yourself up to other types of structures like a trust or a company.
Hmm.
But again, each of these different structures have their own pros and cons.
Hmm.
So if you're going to get to that point, I think definitely speak to a professional that's going to sort of
Mm.
advise you where to
Yeah.
go before you even start the process.
Yeah. Yeah. I think one of the biggest things that people don't understand is the negative gearing, which I think is a bit of a buzzword anyway. I feel like the culture is shifting. I remember back when I first started finance, people were like, "Oh, I want a property that's negatively geared," and I'm thinking, why would anyone want a property that's negatively geared? But I think the culture is shifting where people go, "No, I actually do want, especially with the rising interest rates, they go, okay, that's not as good as what I thought it would be. I want something that is positively geared." But when people buy these properties, one question I wanted to ask you is that oh, sorry, one thing that I noticed, sorry, with that people don't understand is the negative gearing in trusts doesn't exist. Is that right?
That's correct. So if you purchase a property in a trust, essentially the trust would own that property, and the negative gearing losses don't actually come down to any individual beneficiaries. That's probably one of the cons of
Yeah.
having a trust.
Now it is
Uh,
tax deductible though. That interest is still a tax deduction for the trust and the trust total income. Yeah.
exactly. So what will happen is the trust will accumulate those losses
Hmm.
for the next so many years
Yeah.
until a point where the trust becomes positive cash flow,
Yeah.
or positively geared, and then
Hmm.
you can start eating those losses first before you have to distribute the profit out to any beneficiaries.
Yeah.
So it does work out, and this is a whole argument about negative gearing. You'll hear the politics about it, about the investors, the landlords, they're chipping the government because the government is funding all of these negative gearing
Sorry.
losses,
Yeah.
which is true in an instance. But what happens is when you look at the negative gearing equation or the gearing equation, the government's assuming that the property is going to be leased out for say 30 years.
Yeah.
So yes, negatively geared in maybe in the first 7, 8 years,
Yeah.
but then it starts turning positive and it starts contributing to the government's tax base. So
Yeah.
that what that means is the government will start making money from all of these negatively geared properties eventually.
Yeah.
So,
Okay. Got you. So
but
it's not necessarily like a watertight out of paying tax forever type of thing. It's
a
it's
100%,
there's a
100%.
plan. Well, that's good to know. When the government ever puts in a policy in place, you always have to look at the long-term picture as well.
And that's the thing as well with politics, because the parties are generally in there for 3 years. So no one sees what happens to an investment property in year 7, year 8, or year 10,
Yeah.
because they're just worried about staying in power now. So
Yeah. Yep.
that's why there's a lot of bashing with the landlords and the investors as well.
Mhm.
But you know, that's always going to happen.
So there's been a lot of discussion. You was talking about a lot of bashing for landlords and this is not necessarily an accounting question, but I just sort of wanted to get your opinion on it. Um, at the moment, there's a lot of discussion of property investors raising rates, and there's even been some suggestions of putting a cap on raising rates or raising rental pricing in general. Now, of course, the property investor has a mortgage, and their rate goes up. Um, and as their rate goes up, well, they're saying, well, my it's costing me more to own this investment property, therefore I'm going to increase the rate. Now, from the other side, they're saying, hold up, I don't even have an investment property. You're lucky that you get to build your wealth and all that type of thing. Why should we? Why should the landlords benefit that way? And therefore, no, you shouldn't increase my rent, and I should sort of have it capped or have some policies in place to protect me in that sense. Are you on team landlord or team renter?
Look, it's a very tough one because as a landlord, you also have to look after your tenants.
Yeah.
Give them a house that's well maintained, everything that
course.
works, that type of stuff, you have to definitely do, because if you have a good relationship with the tenant, they're more likely to stay. If
Mhm.
they're more likely to stay, that's less changing of tenants and dealing with all of that.
Yeah.
In terms of landlord or tenant, look, it's a very tough one just because there is a housing shortage. So the government needs as much help as they can get.
Yeah.
And if they start capping how much the investors can make, the investors will leave the market. And the problem is only going to get
Mm.
bigger for the government because they're not going to be able to build all these houses. So they
They want
actually need,
houses. Yeah.
yeah,
And renters want houses as well.
everybody wants
Everyone wants
houses
houses.
because there's not enough houses for the people that are coming in.
Yeah.
So either they cut migration, which is going to be a very big sticking point, I think, at the
Mm.
next election, to sort of slow down that demand for housing. Um, that's probably going to be or build more houses. And the
Yeah.
way, it's a very fine balance as well because they can't just go build a million houses tomorrow. It's going to take time.
Yeah.
The industry's not caught up yet. There's lags that happen as well. So they have to sort of have a balance between the
I,
private sector and the government.
I was talking to someone about this the other day and how if we compare ourselves to America, which isn't my ideal comparison, but let's just assume for now. No, if we compare ourselves to America, uh they have they have cities all through the country and they're roughly the same size as Australia, right? Whereas Australia's so urbanized. Do you think that there's probably an argument to be made of maybe moving some of these big business and some big sectors out to more regional locations and sort of building the townships there, as opposed to sort of knocking down or building these big, high-rise apartment buildings in the city to try and curb the property crisis, I guess. And
100%.
a lot of those properties in the city as well that go up, you end up having to pay $1 million for them anyway for a sort of a two-bedroom apartment. So, perhaps there's more need for more development out in those regional areas, but developing housing is only half of the problem. The other half is industry, right? Without industry moving out there, so you need more sort of commercial property potentially, or more incentives to help businesses go regional. Um,
100%.
and that
I
can,
think
yeah,
that all comes down to government policy.
mm,
If the government entices big business to go out there, uh, and it makes it incentivizes them to happen,
mm,
then I do think that big business will follow. If the business case stacks up to set up a headquarters somewhere in regional New South Wales, they will do the numbers, and if it works, it will happen.
yeah,
Just like what's happening now with Badgerys Creek, which is southwest of Sydney.
yeah,
They've The airport's about to go up. It's a few years away.
yeah,
It's sucking in all this industrial, residential, everything. Everything is flocking to the airport because they made a good decision about putting key infrastructure a bit away from Sydney Airport.
yeah. It's good.
You know,
Because
uh,
at this point, everyone's fighting for a spot as close as possible to the city. I've got clients who are buying investment properties and own occupied properties, and they're constantly asking me, well, telling me that they're looking for a property that's, within half an hour of a capital city. And for some people, that's out of their budget, or they have to look at other cities out of state, Perth or Adelaide or something like this, so that it's more in their budget. It made me think, and that's why we had that conversation. Just we need businesses to go out of the city so that we can, utilize that and people don't have to be fighting for prime spot near Sydney Harbour type thing. Yeah. Um, well, that's it's really interesting when we think about the amount of developing, and you mentioned the amount of houses that we need. Now, as you know, one of my biggest sort of passions is private funding, and a big sector of private funding is in development, right? Because it's a lot easier for the developer. They sort of have a capitalized interest. They know how much they're paying. The lender, doesn't ask as many questions as maybe a big four bank, and it allows them to sort of start developing. Now, when you're developing a property, and you did mention that before, when you're sort of investing and a bit about structure, but when you're developing a property, should that be done in a company name or
Look, it all comes down to the individual and
yeah,
how you want to take risk. So
yeah,
if you're probably going to connect it with your principal place of residence.
Hmm.
Uh, it probably does make sense to maybe try and do that small development
Yep.
under your normal PPLR. If you need to do something bigger, I think you're definitely within a company, but the company does make it a bit harder to get funding, like you said. But the company also offers protections for anything that goes wrong within that development as well. So you can also have different shareholders, people that are going to invest in that development as well. So
Mm.
each different type of structure is very determinant on the type of building, the type of project that's going to happen. So
Yeah. Okay. And with planning, how much with planning for a construction or a development project, let's say you're putting up, 5 or to 10 townhouses in some residential area, and you're planning to sell those after. For someone who's relatively new to developing, which is a lot, I get a lot of inquiries from people who are brand new in the developing space, and they sort of want to, I don't know, be Donald Trump or start developing. Which, to be honest, I respect if you want to start developing, but it's a big, big task. And one of the main things that I always tell people is to go to an accountant. Now, I was hoping you could even break down a little bit about what it's like, how an accountant can help with sort of cash flow forecasting, setting up that business plan, and also just helping run the numbers so that there's actually feasibility in the development itself.
yeah, 100%. I think there's a lot of underestimation of costs, so how much actually things cost. If you're going to put up a townhouse, you have to buy the land first, whatever that costs. It has to be enough size to fit how many you want to fit on. Then the council needs to get involved to see whether you can actually build that development on that site. And things start to rack up because things also take time.
Yeah.
So if you're going to, for example, do a construction, you knock down the house and sorry, you knock down the property, you've got approval, you're starting, and then something goes wrong.
Yeah.
An issue with the slab. You have to wait till that gets fixed. They can get fixed in a day, they can get
Hmm.
fixed in months, depending on how many different engineers, how many people are involved. So you need to also have cash flow or cash to keep the project running as well, because you could also have time delays. It could rain. It
Mm.
could rain, for a month. You rain for a month, you stop everything. What are you going to do? You're still going to pay the mortgage, still got to pay all your contractors that are doing the
Mm.
works on site. So you need to have those buffers just in case.
Yeah, that contingency. We actually spoke to I don't know if you know Rav Sagu from Landar Homes, but he came and he did a podcast as well with me, and he was saying that the biggest thing is actually weather. He's like, that's the biggest contingency out of it. He said, yeah, cost of things go up, and there's a few other variables, but he was saying that people do underestimate how much rain can actually delay a project for a construction.
100%. It happened
Um,
actually happened to me. I had did a project in 2010, 2011,
yep.
and it never rained. And then it rained for 3 months over the Christmas break, like from November to January. And it just stopped everything. Like it just completely stopped everything. And it just
What's that called? Murphy's Law or something, where anything that wrong can happen will happen.
100%.
Yeah, it's it's like the world telling you that. I feel we've got a few customers doing developments at the moment. They're relatively new in sort of the development space, and same things happen. It's just things are going wrong, and I feel like that's just a canon event. I'm like, you know what? That's just the universe telling you, hey, it's your first development. Your number two is probably going to go be a breeze, but you have to do the hard yards, and the universe is not going to let you get away with it. You have to learn. Um, now with a conversation that I have a lot with my customers as well, and I wanted to get your thoughts on it too. Everyone's rate conscious, right? Everyone wants a good rate. I get it. You're paying less. Less rate means more profit in your project. Less rate, let's even say for non-development, just in sort of business finance, you get finance, and a lower rate means less cash going out of the business, to repayments and paying interest. Now, I I have a businesses and developers usually come to me and they say, "This is what I want to do. How can we get finance?" And it's not working with the big four banks, they might not have the experience or the equity, or, they might not fit that criteria. And we're able to find them a private funder who can do it. Now, notoriously, private funders are higher interest rates.
Mhm.
And I can see it actually deters a lot of people from just even taking up the project in general. They just go, "Oh, don't worry about it. If I have to pay that higher interest rate, if that's what it's gonna look like, um, then I'll just forget about it." Now, I want to hear from an accounting perspective, because from a finance perspective, it's like, well, look, that's the options, and if the numbers still work out, the numbers still work out. But from an accounting perspective, um, is there an argument to be made if your only loan option is a higher interest rate loan option?
Oh, look, it all comes back down to if it's still going to be profitable at the end. If you're accepting that the amount of profit you're going to make because the rate is higher, it's going to cost you more, is going
Mm,
to be less, and you're
okay.
comfortable, then there's no reason why you shouldn't proceed.
Mm,
So with interest rates as well, you've also got different types of loan products, which you probably know more than me, but sometimes not just looking at the interest rate is the only factor. People should be looking at the comparison rate because that's the rate that includes all the fees.
mhm.
And the different types of products give you different flexibility as well. So you may have a particular product that has an overdraft facility or
Yep.
an offset facility. Yes, the rate could be higher initially, but overall on the project, it could be less because those those features of those products will cost actually less overall for the project at the end of it. So
Yep.
yes, interest rate does maybe kill it if it's way too high, but you
Mm.
just need to be comfortable with knowing that your profit could be less. If you're still acceptable with that type of profit, then and happy to proceed, then maybe you should do it. So
And I guess that's why it's important to do that feasibility, and to check that profitability too. How much is that interest rate going to eat into the profit? And you're right, if it's eating into the profit quite substantially, that the project now becomes unviable, or the profit margins significantly decrease to a point where it's not worth the energy and effort, then that's probably something that could be abandoned. But if there's still meat in the project, and it's going to be worthwhile, and it's going to project you into maybe your next project and the next project, then sometimes that sort of that sort of short-term loan or that higher interest rate loan might be beneficial, to just get that across the line. One of the arguments that we get from major banks, so this is your CBA, Westpac, NAB, when it comes to development finance, is that they don't actually have experience. Whereas with private funding, you don't necessarily need that same level of experience. And so at least you can get your first few projects done, get that experience, and then you can start looking at that lower interest rate loan. But you're 100% right, when it comes to all those different features and all those loans, are just making sure that overall it's going to be beneficial for you. Now, when it comes to planning for tax, um, where and I don't know if this is sort of financial advice, but I'll ask you, and you can tell me if it is or if it's not. But when it comes to sort of tax planning and where to put your money, and putting money into like superannuation and things like that, um, I have a lot of people who come to me and they say, Keaton, I'm not going to retire, like I'm going to retire on my investments. So I don't want to, these are obviously self-employed in most cases. So they're like, I don't want to, I'm going to retire on my investments. And I want to build my business and sell my business, and that's going to be my retirement. And they put very little focus towards superannuation and making payments. Now, we've spoken a little bit about self-managed super funds and how those work. Can you give me a quick breakdown? Because I do want to do I think we spoke about doing a podcast just on self-managed super funds, but I would love to touch on it today. Do you want to give me a quick breakdown of why superannuation in general is important, especially when it comes to tax? And number two, what is a self-managed super fund?
sure. So at the moment, you work for anybody as an employee. Your employer has to put 11% of your salary to a super fund. At the moment, there's a few industry super funds out there. Your super contribution from them would go into the fund. They would look after it for you, invest it, do whatever. Eventually, when you get to retirement, at 65 or 70, you then get access to that cash to use to fund life. Because the actual pension, the pension for a certain group of people will no longer exist, and it's going to be replaced by the superannuation system.
Is
So
there a date for that, or is that?
yes, it's already set in stone, I'm pretty sure. Anyone that's born before a certain year are
Hmm.
not going to get a pension. So I can't tell you the number off the top of my head that year, but
Yeah.
basically, you and I will not be getting the pension.
Yeah.
We're mid-30s, we're not getting the pension, and we have
Yeah.
to rely on our super to fund our lifestyle.
Yeah.
So the government knows this, and it's also made the superannuation system very flexible. So you can
Mm.
actually contribute more of your salary into your super fund. There's a range of deductions and stuff that you can receive for that as well.
Hmm.
And then if you want to take it one step further, is you can actually manage the super fund yourself. So rather than giving it to an industry player to do it, you can actually self-manage it yourself. Of course, you need to know what you're doing a bit because you're going to have all this money sitting in this account, and you need to invest that in a way that's going to make more money for you to retire. Maybe getting all that cash and putting it all into crypto may not be the smartest idea. Uh,
Yeah.
but using that money to put a portion in shares, into property, into hard assets like commodities, like gold and silver. Yes, you could do all of those different types of things. And it comes down to you as the trustee to come up with that investment strategy and then execute it which way you like.
But playing devil's advocate, why do that in your super? Why not? Why if I've got that cash, why can't I just put those funds into my own investments? In my own
100%.
shares, in my own share trading, in my own properties. Why do I have to put that in my super? What's the benefit of that?
100%. So there's two ways of looking at it. Some people max out their personal borrowing capacity or
Hmm.
personal funds in their own name and need another vehicle. They can then use the self-managed super fund system to then acquire and do all that uh, basically on your behalf, but only be able to receive those benefits when you retire.
Mm.
The second side, and then on top of that, you also get the tax benefits of it being in the super fund rather than all that stuff being in your personal name. So if you have an investment property and it's positively geared at the moment in your personal name, you'll be paying tax on it as part of your taxable income with
Hmm.
your personal income tax return. If the property is in a self-managed super fund, yes, the self-managed super fund will pay tax, but it's at a very low rate, which is 15%, and it's in that super fund. It won't impact you personally at the moment.
Right. Okay.
So
So 15% is the self-managed super fund for any
that's
sort of contributions.
so the super fund, the tax rate of a super fund is
Mm.
15%.
Yep.
So you're able to contribute to super of 27,500 per year,
Hmm.
including your employer's contributions as well.
Yep.
Once you go over to 27,500, then you pay a lot more tax.
Now,
So it's
27 and a half is a lot though.
it is
Yeah.
uh,
Yeah, okay. That's interesting. And so right now it's 11% now. That's actually increased a couple of times in the last couple of years, isn't that right? Because I think
it's
it was 9 point, I remember, I forget what it was, 9.5 maybe for ages ago, and then it went up to sort of 10.5, or then it went up to 11 or something like that. Why has there been an increase in this concessional super
Uh,
contribution?
so, so the government has made it or mandated the rate at which the super contributions will increase.
Hmm.
So over the next few years, it's going to continually go up as well. So it's already been legislated. It's going to happen.
Okay. Yeah, interesting. Okay. So we're just going to expect more super coming through. Now, and this is probably before I let you go, but I wanted to draw that back to sort of property developing and everything as well. So with project workers, I'm going to call them project workers, property developers, people who get paid sort of lump sum at the end of the project or when they sort of sell a property. But it probably relates to a whole bunch of different things like commissions or something like that.
Yep.
Are you all good?
Yep.
Oh, sorry, you just turned off for a bit. No, all good. I'll just ask the question again and they can edit that out anyway. But do you need to go?
No, that's all good.
Oh, all right. So um yeah, with project workers, so people who are developers who sell property and make a profit from it, they might not necessarily draw a salary, right? And so they get sort of these big lump sum payments, even commission workers or workers who are getting commission through an ABN or something like that. Um, these businesses might not necessarily pay themselves a salary, but they might pay them dividends, or they might get sort of a director's fee or something like that that comes from the company. And how should they navigate that sort of superannuation thing? Because they're not paying themselves a sort of a regular 10%. Does it come out of that lump sum, or what's the best way to manage that?
100%. So if you're a sole trader, there is no requirement to pay superannuation because you are a sole trader. If you are a director of a company and you get a distribution through a dividend, there's no requirement to pay superannuation as well. However, it is always good to contribute to super for the future because the company in itself will get a tax deduction as well, and it will go into your super fund. So rather than paying more tax, you can pay less tax by actually spending that money going to your super fund and then utilizing that super fund to acquire more assets or to do more investments.
Yeah, right,
So
right.
yeah,
But
it's
you
it's
can't touch those assets until later on in life, still.
100%. So you can't touch it till the end.
Yeah.
But generally, I speak to a lot of people that own properties as well,
Mhm.
and they don't sell properties. So the difference between holding it in your super fund or your personal name probably doesn't make a difference because you're going to hold the asset until you retire anyway.
Mm.
If
Yeah,
you're looking to do quick in-out sort of transactions, buy something, flip it after 2 years, then using your super fund probably doesn't work for you.
probably doesn't work out. All right. Well, look, no problem. Look, thanks heaps, Andrew, for jumping on and having a chat with me. I love your expertise. And now you do have a website. Sorry, you do have a Facebook page where you upload regular advice. Do you want to tell us what that is? Is it just the finance and tax consultant Facebook page, or?
Yep. So if you search me on Instagram, Facebook, Twitter, everywhere, just search my name, Andrew Romano or
Yep.
FTC. Will come up. We have YouTube channel, Facebook page, all that type of stuff. Feel free to come have a look and join the group. We have a free group as well where you can join a masterclass where we
Yep.
talk specifically about property, tax, and SMSF.
Yeah, and it's you and David having a chat about a whole bunch of different tax issues, some really interesting stuff as well. So, yeah, I've definitely even told a couple of people to have a look at it if they've got sort of if they want to do a sort of tax podcast or get regular tax updates. So, I'll get them to have a look at it. But before I let you go, what is one person that inspires you?
Look, this one, it's a tough one. I think at the moment it's Elon Musk.
Elon Musk.
He's
Yep.
just everywhere at the moment. He's in everything and he's just smashing it. So, someone who almost went broke many times, now who's at the top of the world, I suppose.
Yeah, awesome. Thanks heaps, Andrew. Have a good day, mate, and take care. And
Catch
I'll
ya.
see you next time.
Cheers.
See you, mate.